Welcome to Let's Talk Cardano, presented by the Cardano Foundation. In each episode, we delve deep into the transformative world of blockchain technology. Join us as we explore how blockchain is reshaping industries from finance to supply chain and talk with some of the key pioneers at the forefront of this revolution. All right here on Let's Talk Cardano.
The podcasts are organized by the Cardano Foundation, and the views expressed in this series are the personal opinions of the participants. They do not necessarily reflect the views of the Cardano Foundation or any other institution. This discussion is for informational purposes only and does not constitute financial, investment, or legal advice. Welcome everyone to the podcast. My name is Giorgio Zinetti, and I'm the CTO at the Cardano Foundation. This is the first part of our podcast series focused on the Cardano blockchain. Today, I have a very special guest, Massimo Morini. He's former head of rates and credit modeling at Intesa Sanpaolo, former chief economist at the Algorand blockchain. He's professor of blockchain and cryptocurrency at the Lugano University, the Swiss Finance Institute, and Milano Polytechnic. He's professor of fixed income at the Bocconi University, and he's advisor to institutions like the World Bank, the Monetary Authority of Singapore, and a number of blockchain projects. Massimo, welcome to the Cardano Foundation headquarters.
Thank you, Giorgio. Thank you for inviting me.
It's a pleasure to have you here today. Let's start with a softball. What is tokenomics?
Oh, that's not soft at all. No. Well, every decentralized ecosystem, every blockchain ecosystem stands on two legs. One is obviously technology, and the other one is an economic leg that some people call tokenomics and some people call crypto economics. And if you think, for example, of a centralized traditional economic or financial network, in that case, there is usually someone that manages centrally the resources, the public resources of the economy, takes most of the decisions, implements them or gets them implemented and maintained, and pays for that with money raised maybe by taxes or through monetary and the financial system. And once it is in charge, he has the mandate essentially to maintain the infrastructure, the public infrastructure of the economic system. And it may do that well or badly. It may also let the infrastructure collapse. It may decide to change it even if it goes well. But certainly the situation is completely different from the one of a decentralized blockchain economics. In that situation, there is no central manager of resources, there is no central maintenance of the infrastructure, and it is essentially the whole economic community that commits to make it work. So once such an economy is started, you need to have already in place incentives for people to move to that system. You need to have incentives for everyone to make its part. The resources that you need to use for these incentives need to be planned at the level of the protocol, and you need to have an economic design that somehow guarantees, or at least tries to guarantee, a smooth and balanced growth. Essentially, all this economic design, which is not so typical of traditional system, and all this continuous appeal to the rationality of the players for having their commitment and their participation, is somehow the heart of tokenomics.
Thank you. Follow-up question, what is a token?
What is a token? Token is essentially digital unit that represents something that can be in the digital world or something that can be in the real world in some cases. But for sure, a token is something that allows to prove something. If you think of the English language, the word token is used in expression like a token of gratitude, a token of friendship, a token of remembrance. And that means that, I don't know, someone may give you a very valuable present to show that they are your friends, or maybe you and another person could have decided to use some spatial object, some spatial representation to remember everyone that you have divided some property in a certain way. And that's basically the meaning of a token. It's something that allows you to prove something. And the problem is that when the digital world was started, at the beginning of the internet, it forgot completely about tokens. So there were wonderful websites that you could read. You could also start participating into networks, send your maybe your production, your pictures, everything that you thought was of value, but you had essentially no way then to prove that they were yours. You didn't have any stable property, any stable rights in the digital world. It was the blockchain blockchain technology and the economy that was born out of this technology that somehow allowed people to have tokens in the digital world. And now we have a very precise definition of what a token is. A token is a digital unit that, first of all, allows you to prove that you are its owner. So if you own a token, you usually have a private key that allows you to prove that your public key is the owner of this token. You can create as many as you want, but no one can erase them. And you are the only one that can transfer them. And also, with a token, you can use them in a project of yours to give to the participants any different kind of rights or powers. Of course, once you decide to use tokens, you get yourself into the typical issues of tokenomics that we were mentioning before. Now you have to care about those who use them, that these resources have a supply and have a demand. And so in a sense, tokenomics not only regards, what can be the currency of an entire network, but also every project that uses tokens.
You think would it be fair to say that Satoshi Nakamoto with his white paper was the first tokenomic expert? Or
Well, 100%. We do not know who Satoshi was or who Satoshi were, but definitely we owe to them an extraordinary intuition. To say the truth, tokenomics was born when blockchain technology was born. The Bitcoin protocol is not only the first instance of blockchain technology, it's also the first instance of tokenomics. And there had been other projects before Bitcoin that had tried to create digital currencies, to create a good network of value over the internet. But there were a number of issues, technical issues of what we now call Web 1 or Web 2, that did not make this extraordinary platform to share information, which is the internet, a good platform to share value. I think we can name at least three, a client-server architecture that gave all the power to the owners of the servers and made all apps centralized, at times even at a global level, as it happens with some social network or search engines. Then there was a total lack of persistency of your identity in the internet when it came to your property rights. For example, every time you were using a service, you were inventing a pseudonymous identity, a username, and you were agreeing a password with the server that then, however, the server the day after could forget or could impossess. And third, that from the point of view of a person interested in tokenomics and in financial market, as I have been all of my life, is a bit technical but very important. In the internet, there is no objective order of messages. The different packets into which messages are divided do not travel linearly, and different users can see different orders. That's a serious problem, if these messages have to represent also transactions and maybe transactions for something of value. To tell you the truth, even the projects that came before Bitcoin had understood that, for example, the persistency of the identity could be solved using cryptography, using digital signature. And at some point, it was becoming known, at least in a small community, that the use of peer-to-peer networks could solve the problems associated to the client-server system. But what everyone failed before Bitcoin was the capacity to actually use these peer-to-peer platforms as ledgers, where transactions and properties could be in a unique order with a unique vision of the actual economy of what everyone owned and everyone had done. Essentially, the most innovative part of Bitcoin was really being able to solve this problem. And the solution that was found was equally technological as it was economic, with a lot of use of concepts that essentially come from game theory or financial optimization.
Going back to the specifics of tokenomics, develop its own vocabulary and lingo. Let's try to go through some of those words. What is token supply?
Well, token supply is essentially how many tokens are produced for a given project or for a given cryptocurrency. And it is at the same time one of the most important things in tokenomics, and also something that one could consider irrelevant. What do I mean? The sheer number of tokens that you decide to issue for a given project is quite irrelevant. If a project, for example, according to the market, has a value of 10 millions, if you decide to use to issue 10 million tokens, every token will have a value of $1. If you decide to issue 100 million tokens, every token will have a value of 10 cents. But the value of the project remains the same. And, if you own a fraction of this project, the value of this fraction remains the same. Why? So I said at the beginning that token supply is very important. Because what is important is its dynamics, the rules about that or lack thereof. Because if, for example, the supply is stable, and you know that you are only exposed maybe to changes in the market view about this project or its technical problems. But if supply can be changed suddenly, for example, you realize that if the supply is increased, for example, your tokens start representing a smaller fraction of the project. Their value and also their power is reduced because there are other tokens that do that. And particularly, as I was saying, if the dynamics of the supply is not predictable and it's considered not reliable, this can be one thing that destroys completely the confidence in a project.
Can you explain how the token supply can influence the price of a token?
Yeah, it's a little bit what we have already started to say, in a sense that considering that a project maybe has got a value on which the market has agreed at some point, by trading, and that you can see in the market, if someone increases the number of tokens, the same value actually needs to be divided into more tokens. But to say the truth, things are a little bit more complicated because particularly in blockchain, you can, for example, create new tokens, but you may not be distributing them. So they have been maybe created by the same founder that created the other tokens, but he is not distributing them. This may have already a bad effect if it is considered unpredictable, but if the founder is trusted by the community and is saying, for example, that he's not distributing them unless they will be useful in years, that may have no impact. At the same time, if they are distributed, maybe as an incentive to very committed players that have a very high valuation of the product and are not going to bring them to the market, this may also have a limited impact. The impact will be even stronger if they are distributed and then they actually reach the market, so that those that receive that try to sell them. Because essentially what the market does is doing a sort of average of the views of those who want to buy and those who want to sell, And if you create new sellers, that's almost surely will have an impact on the price. If instead certain dynamics of the token supply is fully predictable, or in any case, it can be somehow understood by the market, this may also have a much smaller impact.
When you go to a coin token website to check the price, you get the token supply, the price, and then there's the market cap, the market capitalization. What is that?
Oh, yes. It's the combination of the first two things you mentioned, is the value of one token multiplied by the number of tokens that are circulating. In a sense, we go back to what we were talking about before, When a project is created, there is a certain number of tokens which are created, and then there is a certain number of tokens that are distributed, maybe in time. So in every moment, there is a certain amount that we can call circulating supply. So these are the tokens or the units of cryptocurrency that have already reached the market. And in a sense, therefore, they are those that can influence the price, because they can be bought and sold. Then there is the price. If you multiply the number of circulating tokens by the price, you find the market cap. This is essentially the view of the market about the value of a project in this moment. It's an important number, because obviously it is affected by, the volatility of markets and so on. But it is an objective number that tells you how the market values a project, how it values its ecosystem, its community, and it's not, in a sense, a coincidence that usually the ranking of projects is done by market cap. Notice that it's really important to stress that it regards the tokens that are circulating. Because you may find in the lower lines, of the description of a project, some other numbers, for example, one that is often called fully diluted market cap, which is a more theoretical value because it takes the market price and it multiplies it by the total number of tokens that, according to the creators of a project, will be distributed at the end of the distribution process that may take years, as you know, with Bitcoin. Unfortunately, this number is very theoretical because it's based on the assumption that if all the tokens that are planned to be circulating the next years became circulating now, the market price of a single token would not be affected. That's not true, That's not true, and we had so many examples. If a project has got 50% of the tokens circulating, while the other are expected to enter into the market in years, and instead you actually distribute all of them now, you usually have a strong impact that may be actually either a collapse in the value of a single token or a period of sustained inflation.
Okay, so when evaluating the sustainability or the design of a tokenomics, I guess the market capitalization and the nuances of how the tokens are unlocked and distributed is the most important factor versus the price of a single token.
Obviously, there is always this desire, particularly by those that have created or love a project, to say, okay, but if you consider all the tokens, and that's what I've called the fully diluted market cap, but that's an hopeful number that doesn't represent any market reality.
What is inflation? What drives prices and price volatility?
Well, what is inflation? Inflation, if you consider the way we use this term in traditional economy, inflation is a structural, or in any case persistent, decrease of the value of a currency. And this is often associated to excess supply, of which we were talking. I had a striking example, of this in the autumn of 2019, when I reached the Algorand project. I joined the Algorand project a few weeks after launch, and Algorand actually did not have an ICO at the beginning. There was an issuance of tokens, but for a much smaller amount than what is typical in an ICO. And then there was after that a regular increase in the circulating supply that started a sort of spiral of the price, so that when I joined the project, it was in the middle of this spiral of decreasing prices and increasing supply. And once, after a few months with my group, we convinced the investors and the market that this supply had to be stopped, and there was a vote on the blockchain that stopped this, the spiral of the price stopped immediately. So I was surprised about how effective this idea of demand and supply was, but it was still a small project. And in blockchain, its transparency and the visibility of everything made the logic of demand and supply work very, very, very precisely. To say the truth, inflation and increase in supply are not the same thing. At times, particularly in crypto, there is this habit of talking about inflation simply when the circulating supply in particular, is increased. That's not correct, because an increase in circulating supply doesn't necessarily make the value of a currency go down. What really matters is the balance between supply and demand. So if there is an increase in supply that, however, is matched by the demand, or the demand is still stronger, you can increase the supply and increase the price at the same time. I've seen something happening still in Algorand. I remember one time we even had to reform the definition of circulating supply. The number of tokens was increased, but everyone understood the meaning of that, and also the price increased, without having a decrease. But certainly there is a very strong link between a good management of supply and a logic of scarcity. I think in your question you also mentioned volatility. Well, there's some relationship between the things we are saying, because often that creates volatility in the crypto sector is not supply, but is actually demand. And why demand shifts and moves quite a lot in the long term, in a reality like cryptos. But that's because it's a very innovative technology, a long-term technology for sure, and it reminds me one of my very first experiences in using models and mathematics in markets and for trading and advisory. That was the dot-com bubble. I'm old enough to remember that. And it's funny that some people, I even myself, I use that word because that's the way we often remember it. We call bubble a market in which essentially the kind of stocks that you could buy were Amazon or Yahoo, at some point even Google. Can you call such companies, bubbles? No, but the truth is that because of this extremely innovation that was intrinsic in this investment and a long-term effect, there was a lot of volatility, and volatility in time, and also volatility in a sense of very different situation across different investments. So there were already the jewels that would have become the pillars of the internet, and also many other projects that failed. There is another thing to mention that is typical of all network technologies like the internet or like blockchain, and it is the fact that the value of a network grows exponentially with the number of nodes. And I do remember that there was a moment, even 10 years, more than 10 years after the World Wide Web was already available as a technology, in which a Nobel Prize for the economy, future Nobel Prize for the economy, Krugman, could say that obviously the internet was of no value. That was around year 2000. Just 1 or 2 years after, everyone was using the internet. So there was a very strong discontinuity and a lot of variability in the views about the value of this technology at the beginning. Obviously, blockchain is still in this sector. That let me mention the last thing, but one that is very important and not reminded often enough. Essentially, and that's something unique in history, blockchain is at the same time a technology, an investment in a technology, and also the platform that allows to exchange or to hold this investment. And this platform is unique because it works 24 hours, 7 days a week. It doesn't involve traditional intermediaries, so there is nothing like stocks that are taken away for trading for excess increase or decrease, which is very typical in price. And because of that, structurally, with more trading, longer hours, and more open access, it has structurally more volatility. So there is an element of volatility in the sector that we have accepted because in a sense it's structural and it's not necessarily negative. It's a feature of all the things that we have mentioned. Within this volatility, every single project or chain can actually remain a little bit more protected from that if it has got a management of supply that is based on scarcity, predictability, and when some changes have to be made, a balance with demand.
Some projects have implemented measurements to reduce the inflation or even to have a deflation, some burn-in mechanism. What are those? How does it work?
Well, burning has been a very popular name for many years in blockchain. Is the idea that, exactly as we were saying, that not increasing the number of tokens is good for the value and the stability of the price, decreasing the number, burning tokens may even create, increases in price or in value. The truth is the following. First of all, at least at the beginning, burning was almost always done regarding tokens that were not circulating. As we were saying before, that's usually not as relevant in effect on price or on value as anything that regards what is really circulating.
It affects the fully diluted market cap.
Yes, and the situation is a little bit asymmetric because an excess of tokens that are yet not circulating but at any moment may actually become circulating may reduce the confidence in a project, But if then someone decides to burn 10% of that, this may have no impact, because it doesn't even maybe eliminates the potential fear. On the other hand, more recently, we have seen forms of burning that regarding tokens that were already circulating. Other mechanisms, like for example, burning the fees that are paid by the user, seem to be more effective, and we are essentially testing them now in Ethereum, for example. I think it's still early to say how effective they are because we don't really have a long enough window, but we are starting to build the confidence that these are more effective.
This is a whole conversation I want to have another time with you about how those price mechanics and flow affects the...
That's probably for the episode on advanced tokenomics,
exactly,
that we're talking about, yeah.
Okay, let's now go into the specifics. I would like to cover with you Bitcoin, Ethereum, and Cardano.
By the way, they are three different examples of the vision or the implementation of all the topics that we're talking about. Thanks God, they are three successful projects, so it shows how success can be reached with slightly different choices, but without really going too far away from the principles that we were mentioning before.
I would say let's start with the oldest, like the gentleman. So I would say Bitcoin. Could you talk about the tokenomics of Bitcoin?
Bitcoin tokenomics is the mother of all tokenomics. And as we were saying, it is in a sense a strike of genius, because Satoshi had a fundamental intuition, that he could actually find players that were eager to maintain honestly the infrastructure without giving to them control of the infrastructure, as long as he managed to select those players that were the economically most committed in the network itself. And how did it obtain this? Essentially, once you have created a platform in which every transaction is digitally signed, and there are millions of computers, but even at the beginning when there were many computers that actually stored this information, and before storing that, they check the signature, they actually check that all the tokens, the coins that have been exchanged were really owned by the public keys that were moving them. There are not so many dishonest things that can still be done. The main one is essentially double spending, that once you have some manager that is selected to order the transactions, in that case, the double spending is called the fork. Is the attempt to create, two chains of blocks at the same time. But Satoshi had this great idea, the great idea, as you know very well, but this time, I'm telling this from the perspective of the economist, and not from the perspective of the cryptographer, of the technologist, which is the one that we usually hear. He had this great idea. He decided to select the validators essentially by asking them to prepare a list of blocks, a list of transactions, essentially a block, and then to play with an area of the block in order to get then globally for the block a few mathematical properties, And these mathematical properties are not easy to plan in advance. So the only way to get them is really to try several different possibilities for this additional text until you get these properties. It's a sort of game that may even appear useless. But when the project started to be known even in a small community, essentially in order to be the first to get these properties, and so the next one to put the block, you had actually to make a more and more significant investment in machinery to actually do this computation. And often, again, this happened, I don't know if Satoshi predicted even that, but it happens a few years after Satoshi had launched Bitcoin. This machinery started to be specialized. So that was a machinery that one couldn't really use for anything else. It was optimized, often the processors were ASICs, optimized for actually doing proof of work, because this was the name that was given to this methodology. Because of this mechanism, making a fork, first of all, had become difficult, because one had to actually build in parallel two chains, winning twice, essentially, what he needed to win a chain. In order to actually get something like that, one needed to have a significant proportion, almost a majority, of the computational power in the network, which means that at some point he had invested first millions, then hundreds of millions, in machinery that had the purpose of a validated transaction for Bitcoins. But essentially, the only person that could do a fork, obviously at this point, has absolutely no interest to make a fraud that would actually reduce the reputation of Bitcoin and reduce dramatically the value of its huge investment. So he had created an incredibly decentralized way actually to select the managers that were forced to be reliable by their own investment. And at this point, he could disappear, relax, knowing that Bitcoin had a great future in front of it.
In terms of the main tokenomics figures, the fully diluted token supply is going to be 21 million. Currently, we are at 19 point something million, I believe. Can you talk a bit about how the issuing, what is halving, how are we approaching the 21 million number?
This is very important, because the reason why there was this increasing interest, in becoming validators initially was due to the fact that there was an incentive of newly created Bitcoin that everyone who owned the right to add a block to the chain could add in the block as an additional number of Bitcoin for himself, This incentive, very well designed, because if you think, in a sense, at this point, you actually have someone that already has an incentive to act honestly, because if he does something that makes the nodes not to accept the block, he loses this specific money. But there is something else that was very clever, in the design of Bitcoin. And it is the fact that Satoshi, again with an incredible foresight, understood that at the beginning, in order to start this mechanism of commitment and of investment, he had to give out significant portions of the total market cap of total supply of Bitcoin that was fixed. So everyone knew since the beginning that there was a maximum number. But as the system evolved, he created a mechanism by which every few years the amount given out as a reward was actually halving, until at some point the reward will be zero, and the miners, the validators, will be supposed at that point to make money only from the fees that, as creators of the blocks, they can actually receive. And in a sense, if you think of everything that we have discussed about Bitcoin, we are essentially seeing all the very good points of a tokenomics that can be understood from Bitcoin. One is definitely strong economic incentives to participation. The second one is economic rationality used to incentivize good behavior for the network. The third one is automation in the workings of the system that prevents everyone to manipulate. Then we have the predictability that we had already mentioned is very obviously displayed in Bitcoin. Fixed supply that reassure the participants from the fact that they will not have unexpected losses because of changes of supply. We have seen this design that creates a long-term scarcity that incentivizes holding and somehow protects the value of those that want to stay in the chain for a long time, an initial financial attractions, and a long-term sustainability. I wanted to read the list, as it came from my notes, because I think that all of these principles are very important for a good tokenomics. Of course, there are also some consequences of this, and some of them are quite undesirable. I also have a list, The system is very rigid. I think it's quite obvious that this system works as it is, and the possibility of changing it is very, very limited. It may lead to hoarding of resources, because of this dynamics of scarcity, because of these very high rewards and very big players that take them, and that subtracts somehow liquidity for transactions. It does not involve any sort of planning of resources to be used in the future, maybe for investments and creation of applications or layers above the network. It may actually create more bubble behavior, so increase the volatility, by few of these mechanisms. It makes the times of transactions slow, because to work this system can certainly not have extremely rapid transactions, and also it creates a situation where it's very normal that the fees become higher and higher. At some point, the fees even need to become the way to maintain the entire tokenomics, and they are also associated to the high cost of validating and to high environmental impact of all the proof-of-work machinery. And another thing that I think is worth mentioning is that even if the Bitcoin validation system, for me, always remains decentralized in the sense that there is always competition and can always be challenged, that in practice, often it's really very few players that end up validating transactions. So all very good tokenomic principles we could mention, but also a number of undesirable consequences, And you may have noticed that after Bitcoin, no one tried to replicate Bitcoin, to make another Bitcoin, maybe just with a better technology, because in a sense there was already Bitcoin. And most of the innovation had been in something different, certainly also in some parts of the tokenomics, trying to keep as much as possible of the good features, but without having the shortcomings that we have mentioned.
It seems you want to talk about proof of stake, but I would like to stay a little bit with proof of work.
I had prepared everything
and
to move to the consensus system where I've worked the most and that I probably prefer to any other.
It's again maybe another question that would warrant another full episode. But what I'm curious about is the evolution of Bitcoin and the equation that involves the price of energy, the decentralization of miners, and the halving cycles. When I ask my Bitcoiner friends, is like, do you think that this is a risk, that if there's not enough transactions to pay the miners, this could lead to centralization of mining? The answer that I get the most is, well, but the price will go up anyway, right? So it's what's your view on that? You think you think there's a risk if the price doesn't go up, only the miners that have a better access to cheap energy will control the network? Is there a risk here?
Well, I think that in my explanation, from the point of view of an economist, it's pretty obvious that the workings of Bitcoin are much more associated to the hardware and to what in economy we call the fixed investment than the variable investment. I do remember, because I've been in this field from long time, in 2013, 2014, everyone was talking about the usage of energy. While in the years after, everyone realized that the biggest economic aspect was actually the kind of fixed capital that was being built in the mining farms, in a sense. So I've never given, and I keep not giving, a lot of importance to energy. Of course, the cost of energy may decide if miners are more in a country or in another one, and that's definitely not good, But wherever they are geographically, the mechanics of proof of work is based on the hardware. So it may be something like quantum computing that may have more of an effect, from the point of view of the working of its tokenomics. From what I can say, I have to say that the transition from native rewards and, essentially the mining rewards, and miners paid by fees is happening already, in a sense. So I have no reason to think that this will go badly. About, the effect of what may happen in the long term when halving disappears, or what is the effect of halving as long as we still have halving, that's probably for a more in-depth episode, definitely.
I think it's also worth mentioning that many Bitcoin miners are using sources of energy that could not be used otherwise, like renewable energy that must be used.
Of course. From the point of view of the economist or of the tokenomist, I've always thought that, in a sense, that the consumption of energy of Bitcoin was so clearly related also to some of the qualities of proof of work that it was obviously indesirable, but also at the same time, part of a working system. And there are many systems that consume a lot of energy. Let's not mention, how much energy is consumed now by artificial intelligence. I think it's already much more than the one consumed by Bitcoin. But it's also true, yes, that I do believe that exactly the success of proof of work created somehow a better alternative. And let me tell you what I mean. When and it's another tribute of respect, in a sense, to Satoshi and to the world of Bitcoin. But when essentially Bitcoin was created, no one had the concept that could exist digital tokens with a lot of long-term value. So in a sense, when he needed to create, in a sense, a community of players that were strongly involved into the economy of Bitcoin, and because of that economic stake, they could be expected to be rationally honest and reliable. Probably the only way, or probably the best way he could do that, was with the idea of requiring a display of computational power and computational effort. But, and that happened, started to happen a few years after Bitcoin, once it was evident there could be tokens of high economic value, it was enough to see the value that Bitcoin had, it became somewhat, in my opinion, really redundant to ask for proof of work, because one could already measure the commitment of a player into a blockchain ecosystem simply by measuring how many tokens they were holding. Essentially, even in Bitcoin, this proof of stake had already become very effective, because the miners were so loyal to the system, not only because of their investment in technology, but also for the part that they had kept into tokens, that also would have been dramatically damaged by any act of lack of honesty. And so I think that it was really a great economic idea that understood deeply proof of work to say, okay, now we can have an alternative with the great advantage of not requiring energy, not requiring pollution. And that is called proof of stake. In a sense, that also is a tribute of respect to the mother of all tokenomics, because this logic of stake, economic stake, was already in proof of work, and now it becomes the heart of a new consensus algorithm that is called proof of stake. Obviously, to make this a formal consensus algorithm, there were a few technical issues that had to be solved, for example, how to make the selection, in any case, randomic, as it happens naturally in proof of work. In proof of stake, that was a little bit less obvious. Now a solution has been found, in a verifiable random function, a topic that I know a little bit because they were actually created by Silvio Micali, the founder of Algorand. Even if, to say the truth, Algorand was not the first to use verifiable random functions. Ethereum was not the first one, even if now is definitely the largest user. It was actually Cardano that used them first, to say the truth. But now, definitely, we have several alternatives of very solid proof-of-stake algorithms.
Okay, let's move to Ethereum. Can you talk about its economics?
Well, Ethereum is an incredible example across all of its history of, in a sense, desire to innovate over Bitcoin, eliminating some of its most undesirable aspects or adding features without, however, taking any excessively big step away from Bitcoin tokenomics, Because, as everyone probably in the audience know, Ethereum was created by Vitalik Buterin, and he started building that in 2014. He was at that time considered one of the biggest experts of Bitcoin, and he wanted to make a sort of version of Bitcoin that was more suitable to host decentralized apps. So first of all, he introduced smart contracts. He also eliminated the hard cap to the number of tokens issued. It makes proof of work easier to make the chain more scalable, but it did not have the courage to abandon proof of work. It didn't have the courage to go away from such a successful tokenomics, in the sense of of allowing the existence of a blockchain. And he said since the very beginning, however, that once the chain would have been mature enough, he wanted to abandon proof of work and move to this new system that started to have some, at least some discussion about that, and also some early examples, that was proof of stake. And again, he actually waited until 2020 to really start, to shift part of the network to proof of stake, and I think until 2022, if I remember correctly, actually to do the merge. That was really the shift from proof of work to proof of stake. But all the choices he made, in my opinion, reveal a clear desire not to take an excessive leap from an economic point of view from the situation that Ethereum had before, when it had proof of work and already a community of validators that were essentially miners, a community that probably Vitalik did not want to lose. And so you see some features of Ethereum proof of stake. First of all, a significant minimum amount of tokens that you need to have to become a validator. like miners. You cannot be a miner with a small amount of tokens. And actually, to be a miner, you require more than the minimum in Ethereum. But the minimum in Ethereum has a value of $100,000. That's the value it had. When
32 Ethereum.
Yeah, exactly. And since the very beginning, there was a logic of locking. Even the first validators before the merge, in order to become validator, had to be ready to lock for an unpredictable period of time that then was almost 1 year or even more. And that's again, is the logic of mining, in which you have such a big investment that cannot be sold for anything else. So somehow you are locked into the success of Bitcoin. And in my opinion, even slashing can be read under this point of view, to make sure that you, in case you make a fork, you suffer as a miner would suffer, from a decline in the price of Bitcoin. This is forced through the logic of slashing, which is an additional punishment for those that make forks. That, by the way, involves the beginning of a locking period. So it's sure that you remain in the chain with all of your stake, and you suffer all the consequences to reputation that may come from your bad actions. And if this was not enough, there is also a part of your staking which is taken away. To tell you the truth, now slashing is very popular. Also, other new projects are using that. To say the truth, from my point of view, it's another thing that is still very untested. Only, I think, 0.4% of the Ethereum validators have ever been affected by slashing, and there is only one example that involved the majority of them. But that's not everything that I want to mention about the Ethereum tokenomics, because there are also a few things that are different from Bitcoin. One, as I said, is the lack of a hard cap, of a fixed supply. And the other one is pretty high fees for validators that, by the way, grow with the amount of staking, which is while the fees, in Bitcoin are fixed, and then they are divided by everyone that tries to do proof of work. Instead, in Ethereum, if the stake increases, there is an increase potentially even in 100% of the circulating supply staked. So that's a little bit unpredictable, because now it's a smaller fraction that is involved in staking. However, the relationship is not linear. So if staking doubles, the rewards do not double. There is a square root relationship, but still it grows, with. And so what could be a way to compensate this impression of excessive supply, excessive inflation? The idea was to introduce burning of the fees, of a fraction of the fees that are paid by the user. They are paid by the protocol and burned. That seems to create a dynamics that for these few years of examples that we have seen make some sense. We have seen a period in which Ethereum became deflationary. Now it's back to being inflationary. We are observing an interesting mechanism.
So I think since launch of proof of stake, Ethereum has been deflationary, and as you said, it
has turned inflationary recently.
Yes, but since launch, okay.
Yeah, no. Recently, we are now seeing also it back to, and so far we are seeing, the expected connection with the market behavior, but still to be studied properly.
And it's heavily influenced by the usage, right? In the moments of high usage, it becomes deflationary,
which is not necessary. May risk what in traditional economy we call a pro-cyclical behavior. Which means that when things go well, you make them go even better, and when they go badly, you make them go even worse. But I've not studied that enough to have come to this conclusion yet. But it's one thing that needs to be tested and studied a little bit.
Okay, so we talked about Bitcoin.
We didn't mention Cardano yet. And Cardano is a very nice example. Now, by the way, Cardano proof of stake started before Ethereum, And it's interesting because it doesn't, it's curious in a sense, because from several technological points of view, it remains more similar to Bitcoin than Ethereum is, for example, the usage of UTXO. But from a tokenomic point of view, it doesn't seem to be so obsessed to put additional element of strengthening, to proof of stake to make it similar to proof of work. It seems to rely a little bit more on the mechanics of proof of stake, and I tend to agree, because, for example, Cardano doesn't have any locking of the staking. And I think that has got some logic because, and that's not only my experience, in blockchain, it's my experience in markets for 25, 30 years, that leads me to think that proof of stake has got already its sort of locking, because it's not easy, unless if you are a small player and you want to sell your stake, no problem, so that it doesn't have so much effect, on the consensus system or on the tokenomics. But if you are a large player, that matters for the validation and for the tokenomics, is very hard, to make a fork and then go out, liquidate your investments without impacting the market, And everyone that buys knows that it would be impacted, so it's very, very hard to liquidate. There's a sort of automatic locking, which is due to what we were saying, a sudden sale of a significant, but when I mean significant, really, basis point, so fractions, percentage points are already enough to have a serious impact, that would hold hard, first of all, the dishonest user that then tries to run away. And another thing in which Cardano doesn't want to replicate, in a sense, also the shortcomings of Bitcoin, is having a design that allows every user to participate. And it does it with an innovation in the logic of proof of stake, which is called delegated proof of stake. Notice, it's an innovation to make it formal, because every proof of stake in principle, can create some form of market for delegation. But in Cardano, this is fully formalized, and it's a way to balance the need to rely on somehow really committed validators, and however allow even the small players to participate, because in this case they can participate delegating to large pools. And we are getting near to one of the features of Cardano that I think are more interesting and more peculiar, because there are other ways in which Cardano actually protects himself, from the risk of having, let's say, a tokenomics too different from Bitcoin. But these are embedded into a particularly structured and particularly algorithmic design, parametric design of rewards, of resources that can be held in reserves or used for investments. But this definitely requires an entire episode of its own.
Going to the basics of Cardano, I ask you, I know, what is the token supply, the fully diluted?
No, in this, Cardano is definitely following the Bitcoin path. It's 45 billion and it's fixed.
Billion with the B.
Billions with the B, absolutely. And yes, because considering in this sense, there is an order of magnitude of difference from Bitcoin, and it's fixed. And its distribution, however, is algorithmic in a way similar to Bitcoin, because it is not so rigid. There are elements of flexibility that depends on some automatic mechanisms, for example, how much is released from the reserves as rewards to the validators depends on the behavior of validators themselves. If they act better, they receive more rewards, otherwise they receive less. So the incentive is embedded into this parametric system, and it is there has always been, very limited changes that were possible with precise rules to make changes, and these changes are becoming, now with the Voltaire era, increasingly democratic. But from the first examples of the constitutions that we're seeing, there will be, in any case, very precise procedures and a lot of limitations. And that's something, in a sense, that follows the principles that we were talking about before, the principles that predictable tokenomics is usually working better than one can have unexpected changes. And at the same time, however, having mechanics that do not make the system completely rigid may turn out vital, in the future.
We mentioned the shortcomings of proof of work and what are the answers to those shortcomings. What could be the drawback of a proof of stake system? Is there a concern about smaller project where hoarding could lead to centralization and 51% attack, or is something suitable only for a certain size of projects where there's a escape velocity has been reached?
Yes. In a sense, first of all, I said, that proof of stake would have not been possible as the first system to create the first blockchain. But this weakness of proof of stake, that it works better when it's large and mature and there is already, in a sense, regards every project that decides to use proof of stake. The so-called bootstrap period is very difficult.
Yeah.
I was part of it, and I was solving some of its problems when I joined Algorand. And believe me, the bootstrap of a proof of stake system is complicated. Is a difficult period. And that's probably also the reason why Vitalik did not want to start with proof of stake, even if he was already talking about proof of stake. One approach, was even Cardano was very explicit in that, it planned the bootstrap, changing the decentralization parameters, waiting, to create, to move to the Voltaire era where things can be governed. Yeah, this needs to be managed properly. Small projects that are proof of stake and do not care enough to these aspects, they risk a bit, yeah.
All right. I have some more fun questions for you. I want to hear your take. We mentioned that token supply is an arbitrary number, so I have a question for you. If Bitcoin supply was 21 billion instead of 21 million, what would you think would happen to the price, or what would change?
It depends on if the decision had been taken, by Satoshi when he published its paper. There would have been any difference apart from those that make Bitcoin merchandising, that should have made things bigger, to keep all these additional zeros. But there wouldn't have been any changes. If today someone could imagine a Bitcoin with an increase in supply, that instead would be a tragedy, obviously.
But I looked it up.
We are protected from that.
In the traditional finance, when you do a stock split, there's usually a short-term boost in the market capitalization, but that it returns to the market is kind of rational. But on the short term, there seems to be a positive effect. I've been told by many friends and random people, I'm buying Litecoins rather than Bitcoin because it's much cheaper. And
it's interesting. In the long term, this is completely irrational, so you should only look at the multiplication of the number of tokens circulating and non-circulating, and you have the two relevant measurement of the value of the project. In principle, dividing them by less or more, the larger or smaller number, doesn't have any impact, and in the long run really doesn't have any impact. In the short run, or for small players that obviously do not subject their investment to precise computations, such things, like someone that say, okay, this one is cheaper, or some other investors at times say, but I prefer this one because its value is more than $1. And you say, okay, but maybe it has got 10 tokens, while another one has got a value of 20 cents with 1 billion tokens. Yeah, this element of irrationality do not matter in the medium or long term. At times they create noise, in the crypto markets, to say the truth.
Yeah, and I mean, there's some practicality aspects. If there were only 1,000 Bitcoins or even less, you would for accounting, you did send me 0.000.
That's correct. In fact, if you notice, and we mentioned also Cardano, almost all projects that came after Bitcoin decided to issue more. Probably even Satoshi did not expect such a success, so he did not expect that the unit of Bitcoin, and in some cases even the unit of Satoshi may be too big, yes.
But this is something that Bitcoin could fix once it will reach 10 trillion market cap. They could vote for doing a stock split.
In that case, definitely would have no impact. That no. I mean, I was imagining if someone would say that the 21 billion did become 42 because there will be new issues. That would be funny, but we are protected from that kind of forks, I think.
If you could go back in time, let's say 15 years ago, what aspects of tokenomics would you advise Satoshi or Vitalik to change in their project?
Well, I tend to think, that they did things so difficult at that time that giving them any kind of advice would be ridiculous. In hindsight, they were incredible. They made incredibly good choices. But I would say that every project, that managed to be, let's say, at the top of the most visible chains for several years requires a lot of admiration, And we can see with projects like Bitcoin and Ethereum that now size itself and the length themselves starts being visible also in a lower volatility, So I think that at the beginning they did everything the best way, because any change could have had an impact that in a sense was partially predictable. So I can give you a suggestion probably for all the other chains, but not for the largest tools.
What are some red flags that you see in the tokenomics of some of those projects that have not reached the success they expected? Or when you look at the new project, what are the negative factors in a tokenomic design that you look out for?
Well, it's a little bit. Many are things that we have definitely mentioned. When I see, for example, projects that seems to reason more in terms of fully diluted market cap rather than actual market cap, so they maybe come out, with a very tiny fraction of their circulating supply. Maybe after a hype, of a long period, the price appeared to be large, for every single token, but needs to be multiplied by those circulating tokens. That's the value of the project. But they reason, as if everything was circulating, while the reality is that if instead maybe less than 1% or just a few percentage points is circulating, that's a big risk, because at some points they will have to issue, and the impact of this supply relative to this small market cap could hurt them, definitely. I also, for example, I'm a little bit perplexed, again, looking at the deficiencies of things of this period of consensus methods that seems to be based almost completely on slashing. That's essentially untested, and there is something more, even if apparently that becomes a completely economic consensus method that also should worry a little bit by itself, this fact, because you punish a person economically. It's sort of much less efficient, than systems that automatically punish, the validator by reducing, by the fact that the token reduces in value when actually something bad or something dishonest is done by the validator. I think that's a point that it would be great, to explain better, even to regulators, that the fact that blockchain projects have tokens that are associated to their success in many situations is good, and obviously you can still find the super rich founder we have seen that doesn't worry of damaging everything and so on. That happens only in very centralized situation. In reality, instead, the fact that a community has a shared interest in a token makes, when the community is mature, look at Bitcoin, look at Ethereum, that's become an element of strength of an decentralized economic system compared to decentralized systems or systems that do not have a token.
It was great. One last question. If you were to design the perfect meme coin, What would be the economic of it, and would it be a cat or a dog?
It would be Elon Musk cat.
Elon Musk cat. All right. Thank you very much. Grazie mille, Massimo.
Grazie, Giorgio. Thanks a lot. Thank you, everyone.
Thank you for joining us on Let's Talk Cardano. For more insights and deep dives into the world of blockchain, don't forget to subscribe and reach us at cardanofoundation.org, where you'll find extra resources and content on all things blockchain. Leave us a review wherever you enjoy podcasts. Follow us on social media and stay tuned for more coming soon.